Hi, everyone. Welcome to today's webinar. My name is Fawad Razaqzada, market analyst with Think Markets. I am based in London, and my colleague Victor is joining us from Sofia in Bulgaria. So today's webinar is obviously the live market analysis, which is what it says on the tin, really. It's a live market analysis. We will talk about live charts. We haven't really prepared anything, and we encourage you to ask us questions during this webinar, and we'd be more than happy to answer any questions on any tradable market, that Think Markets provide with us. So yeah, if you have any questions, please feel free to ask us at any time. Okay, so we will share the live charts once you've had a quick read through this disclaimer. I'm going to read the first paragraph with you. These webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investment based on any information in this webinar. Please remember that the spread betting and trading CFDs carry significant risks and may not be suitable for all investors. So for those of you who are new to this webinar, we have this webinar happening every Tuesday at 11:30 London time. It's predominantly a technically focused webinar, meaning that we talk about levels where we think price is heading to based on some technical rather than macro reasons. But yeah, we do have the macro backdrop in the background as well, and we do briefly touch on it as well. And speaking of which, it's going to be a very interesting week. We have lots happening. It looks like the reflation trade is back on, with risk assets bouncing back this Tuesday morning. Stocks are higher, dollars weaker, bond yields have bounced back. So investors are in a risk-on mode today because I think it's because of optimism that the vaccine developments are going well in the UK. I think around 4 million people have already been vaccinated in the UK, which is a big success story. And if that rate, if we carry on at that rate, hopefully within the next few months, things will start to get back to normal. Hopefully, lockdowns will probably end, at least in the UK. But many other countries will likewise, join the UK in vaccinating their citizens. And hopefully by around the middle of the year, lockdowns will come to an end in most of the developed economies and hopefully other regions of the world as well. That's the hope. That's how the markets have been behaving since a few months ago, with risk assets rallying. And that trend looks like has resumed today. And a lot is happening this week. We have earnings from companies like Bank of America, Morgan Stanley, Netflix. In addition, Joe Biden will take over as the next US president on Wednesday, so tomorrow. We'll also have lots of policy decisions from central banks, including the Bank of Canada, Bank of Japan, and the European Central Bank as well, which is happening on Thursday. And then on Friday, we have some really important Eurozone PMI data that will impact the euro-dollar, no doubt. Okay, so that's what's kind of driving the markets at the moment. But as I say today, risk assets have bounced back. So we will talk about those when I share the live charts. In fact, let's go straight to the charts now. And I'm going to start off with looking at the dollar index. Now, the dollar index has been, or the dollar as a currency has been in a strong downtrend ever since peaking in March. So since March, all risk assets have rallied, and the dollar being a kind of a safe haven currency, it has fallen against its major rivals, including the euro, the pound, and to a lesser degree against the yen as well. In recent weeks, though, the dollar did rebound a little bit off the lows. To me, that looks like a short covering rebound. I expect the dollar to continue heading lower to at least take out the 2018 low, which comes in around here somewhere. So previously, we bounced from around 89 to 90 support area, which was previously the base of consolidation that led to that breakout. The index came back down to to test this area, bounced, but I think the fact that we got so close to the 2018 low right here and not taking it out, it kind of looks to me that this could be a short covering bounce ahead of a sharper sell-off to take out liquidity that will be resting below the 2018 low. Then what happens after that, I have no idea. But I think in the medium term or in the next couple of weeks, we could get down to 2018 low. And then from there, if there's acceptance below that level, then the dollar weakness will continue. However, if we see a quick rejection back, for the index to break through the 2018 low, then goes back above it, creating a hammer-like candle or whatever on a daily basis, then at that point we may see a nice recovery for the dollar. So that's the scenario I'm watching out for. But also, it's always a good idea to have an open mind, and by that I mean it's possible that the dollar may have already formed a low, and for that to confirm, we will need to see the breakdown of some further resistance levels, including this bearish trend line. So if that trend line breaks and price goes above it, or the index goes above it on a daily closing basis, then at that point, I will drop my short-term bearish bias on the dollar index. But so long as this bearish trend holds and key resistance levels, including the 91.75 level, this low here, remains intact, I would still lean towards a bearish than bullish argument for the dollar. So with that in mind, let's now go quickly through the, in fact, I'll come back to the dollar. Let me just show you what's happening. I talked about bond yields, right? So this is the 10-year US yield. If you look at the, this is the weekly chart. Yields have been rising in the last few weeks, months even. A couple of weeks ago, we broke above a key level of potential resistance, or it was resistance, but we broke through it.
Around 1%.
Around 1%, indeed, Victor. And that was a clean break. So this is possibly a bullish development for bond yields, meaning bearish development for bond prices. So with bond prices breaking down, it suggests that investors are kind of looking ahead of time and are no longer expecting further stimulus from the Federal Reserve and other major central banks.
Well, it's not like they're not expecting it at this point. Yeah. We need to add here that stimulus is ongoing, and despite the Fed buying bonds and therefore holding yields down, yields still continue to rise, which means there are more sellers of bonds, and they are overpowering the Fed's buys, and that basically maybe if you scroll a little bit back to see how was this happening during the previous cycle when the Fed was still purchasing bonds between 2009 and 2014, was it 15?
Yeah, so somewhere like here.
Yeah, so we have seen episodes of bond yields rallying, and this whole story is unfolding rather long term. So we need to take into account here that whenever the Fed sees yields rising too quickly, they might react. But at this point in time, this has been going on really slowly. So hence there is no action from the Fed.
So in other words, this is just a drop in the ocean kind of thing. And unless yields rise maybe above 2%,
towards 2%, that's what most kind of reputable bond guys say that is the line in the sand for the Fed to intervene and to attempt to keep rates lower. But until we reach that point, that could turn into a major rally for the dollar, actually, and consequently, this could keep a lid on gold, the silver, which have been outperforming in this environment.
Yeah,
absolutely. Ever since 2019. When this started.
Yeah, no, that makes perfect sense. So obviously with a few central bank meetings happening this week, we may see yields come back down. If central banks talk dovish about their respective monetary policies. This is the 10-year German bonds weekly chart. As you can see, this has also been going up slightly in recent weeks, and the European Central Bank is meeting. Much less so, much less so, yeah. But it has stopped falling. That's the key point. So this is obviously a reflection, in part, a reflection of the reflation trade that we keep talking about with growth stocks, weakening a little bit, and value stocks gaining momentum, and other risk assets remaining supported as well. It's kind of a reflection of that. But let's see what the upcoming central bank meetings, will pan out and what they will say about these the recent stabilization in yields. Will they attempt to, push down long-term yields once again? Remains to be seen. But going back to the currency markets, and we talked about the dollar hitting potential resistance. Victor said that the yields will probably prevent the dollar from sliding too sharply, and which means therefore that the likes of the euro dollar may not manage to rise too aggressively from current levels. The euro dollar has bounced back today, but it has done so after falling quite sharply in the last couple of weeks. So the euro dollar looks like it's in the middle of nowhere to me overall. In the in the long term, it's still bullish because the trend line is there. It's not broken. The moving averages are still rising, suggesting objectively telling us that the trend is bullish. However, short term, we have seen some bearish developments. For example, the euro dollar has broken out of this bullish channel on the daily. We have gone below the 21-day exponential, and we've broken down some support levels, including this level right here at around 121.30 to 121.40-ish.
Yeah, a level which we are currently testing today
right now. Yeah,
and it might prove to be significant resistance. And assuming everything goes well, that's kind of a theme that is going on in the market. That assuming everything goes well with the transition of Joe Biden into the presidency, we might see a continuation of this rally in the dollar and the return of the US reputation as a global leader. For how long is this going to last? Nobody knows, but the market doesn't care.
The market doesn't care indeed. We're seeing a similar picture. This is what I was expecting from the pound previously. I'm not sure if I still hold this view because I expected the pound.
Tough there. A lot of sellers above 137 and above 136. It's starting to struggle.
It's starting to struggle indeed. I mean, the pound should have gone up more aggressively given what happened with Brexit. No deal Brexit was avoided. That should have led to a sharp rally in the pound. It didn't really, and the fact that it hasn't kind of makes me worried a little bit from a bullish point of view that maybe this could turn into a possible top around here, but
yeah,
it's early days.
As they say in football, if you don't score,
if you don't shoot, you don't score.
Well, there's been several shots on part of pound bulls to break through the 137 area.
Yeah.
But they have all failed, and one wonders when might these bulls start taking profits and push the price lower.
Yeah. That being said, though, I would
still
not.
Constructive.
It's still constructive from a bullish point of view. Yeah.
Because we don't want to get ahead of ourselves.
Yeah. So it's just a warning that we are highlighting here. It could just be a pause before a much sharper rally. Who knows? But the fact that it hasn't gone up as sharply as we had expected it to do, this is a possible worrying sign. However, for the bears to step in aggressively, we do need to see the breakdown of some key levels, including the 134.80 level, which is this level right here. We tested that level a couple of weeks ago, I think, bounced there. So a daily close below the low of that candle would probably mark the start of a new bear trend that could see us go all the way down to 135, possibly towards low 130s in the next couple of weeks. But we will cross that bridge if we get there. For now, the bullish trend remains intact. So regardless of my concerns and Victor's concerns, objectively, we have to remain objective, right? The path of least resistance continues to remain to the upside. And the euro pound is looking interesting. The euro pound has created this head and shoulders pattern. Obviously, this is a reflection of a no deal exit being avoided. So this suggests that the pound is possibly going to strengthen compared to the euro in the coming weeks. So this could mean two things for the when. Yeah. The question is when, obviously, while we could speculate about the timing of that. One thing as technical traders we could do is literally set an alarm on this chart at this level, the neckline at 88.65-ish. Look how many times that level has been tested.
The 88.60, 88.70 area seems to be the zone that is limiting pound gains for now.
Yeah,
and we have seen another test last week of that level as we expected. Yeah. However, for the time being, it's not broken. So some profit taking could be in store. Who knows? We'll see.
One thing though with a level like this is the fact that it's been tested so many times in the past. And we haven't really rallied away from it in a meaningful way. To me, that looks like a level which is likely to break now because of the fact that we've tested it so many times and we haven't gone away from significantly away from it. So when a level gets tested multiple times, the more times it gets tested, the likely it will break in the direction of the test. So in this case, I think it's going to break down. When it does break down, then people who like to trade the head and shoulders pattern, they would be stepping in, which could then see a continuation lower for the euro pound, which therefore could mean that the pound dollar could either go up, or it could mean the pound against dollar could hold, causing the euro dollar to slump. So one of the two things could happen if you trade these two currencies. So either the pound dollar is going to hold and the euro dollar is going to slump, or the pound dollar is going to rise at a faster pace than the euro dollar.
Yes.
Yeah. But if you want to take the US dollar out of the equation, then you might as well just trade the euro pound, the cross.
Yeah, I was actually seeing this curious price action in the final days of 2020, when selling in the euro pound pair pushed down the euro dollar rate. That was really, really bizarre. And you know, it could reoccur pretty soon. We need to watch out for this.
Absolutely. So do watch the euro pound. It is important currency. You know, among the crosses, the euro pound is one of the major ones, right? So it's heavily traded compared to the other crosses. Obviously, it's not as heavily traded as the euro dollar or the pound dollar, but it's not too far off the pound dollar. And so do watch the euro pound closely. Now, speaking of you know, crosses, one of the crosses that caught my attention yesterday was euro yen. I shared the chart of this when it was testing this at 125.10 level. The reason I highlighted that level yesterday was quite simple, really. Previously, this level was resistance, as you can see here and here and here. We then broke through it cleanly.
It has proven to be a support now.
Absolutely. So this goes to show that once a strong level of resistance breaks, the next rounded retest is going to provide you a bounce at least. And so it has proved once again. So anyone that says to you technical analysis doesn't work, show them this chart. You know, it was a very easy trade because it was a clean level. It hadn't been retested before, on at least not on a daily basis, on a daily closing basis. So that's a nice bounce. The euro yen looks like it wants to push higher from here, which is again showing potential strength for the euro. And more to the point, it shows weakness for the yen. Now, the yen is a safe haven currency, right? And we're seeing the dollar weakening as well. So, in other words, this is pointing to continued risk-on trade, which means, therefore, if you trade the stock indices or individual stocks, this is yet another indication that the market wants to see risk assets push higher from here.
Defying all gravity and logic.
Doesn't exist in the markets. Likewise, for the pound against the yen, we're seeing a similar picture. I have been bullish on this market for a while now, especially when it broke the first of the two bearish trend lines. We are still holding above the broken bearish trend, but the price action has been quite ugly within this.
It's been very choppy indeed.
It's very choppy, yeah. So, you know, if you trade this, good luck to you. But it does show that, you know, we've seen lots of choppiness, which means that you have to pick your levels carefully, as you would anyway, but more so in this case. And you'd have to have kind of wider stops than would otherwise be the case in a strongly trending market, because this is not a strongly trending market. So if you trade this, just ensure that you do have a stop loss and that's not too close to the market. So let's talk about the dollar yen, because we've spoken about these yen crosses. What about the dollar yen itself? Well, the dollar yen has been really frustrating from both.
The ultimate chop trade.
Chop fest, yeah. It's been quite a chop fest. It has been a struggle in either direction. Now, the reason for this is really simple, because both currencies are considered to be kind of safe haven in this environment, and both of them have weakened against other currencies since March. The dollar, you know, on a marginal level, the dollar has been the weaker of the two currencies, and that's why we're seeing a kind of a downtrend a very weak downtrend, but a downtrend nonetheless, which therefore means that if you are bearish on the dollar or bearish on the yen, then the currency you want to trade against should be the US dollar, because the US dollar has been weaker of the two haven currencies. And well, it was until most recently when it broke above this bearish trend line. The fact that it hasn't kind of followed through makes me wonder whether it's got any further legs to go. But this is a market I would avoid 100%, just because of the way it's acting. There are much better opportunities elsewhere. So I would not waste too much of your time talking about this market. Let's go to some other markets. Let's talk about indices very quickly, and then we'll talk about gold and silver, and then we'll wrap it up there. So starting with the S&P 500, the trend is still bullish. The market's making higher highs and higher lows. Recently, we went into a period of consolidation, and now it's bouncing off this bullish trend line. So it looks like it wants to push back towards the it wants to push towards the all-time high, which was hit earlier this year at 3,831. Looks like that level is going to be taken out. We do have lots of earnings coming up from the US this week and the week after, so watch out for those earnings. Starting with Netflix today. If Netflix beats expectations, then that could potentially lead to gains for the technology sector, and so the Nasdaq 100 could be in focus. Like the S&P 500, the Nasdaq is holding its bullish trend line, the short-term bullish trend line, and the 21-day exponential. So the trend remains very strong in both markets. Therefore, if you're feeling bearish on the stock markets, what you want to see first and foremost is a sharp sell-off, okay? And then you want to see some choppiness, and for the indices to make lower lows and lower highs before stepping in, because every time it has sold off, it's bounced back really quickly, as you can see in the past. So we need to see the index weaken first before it becomes bearish. But yeah, I wouldn't touch it from a bearish point of view just because it's been going up. We don't know how long it could this bullish trend could last. It could last a lot longer than one would expect it to.
Anyone expects, yes.
Yeah, and this is no longer valid.
That's what happens with bubbles, doesn't it?
Yeah. So bubbles are not bad from a trading point of view. People see bubbles as being something negative. Well, the only people that see bubbles as being negative from a trading point of view is the people that try to sell it short. You don't want to do that. With bubbles, you want to be going with the direction of the trend, because it's a very easy trade. Or usually it is a very easy trade to go in the direction of the bubble. So don't fight bubbles until the markets tell you it's time to do that. Right now, it's not telling us that the bubble has bursted. A similar picture for European indices. I was previously expecting the DAX to rise from its bullish trend line. It's kind of broken it, hasn't it? If you zoom in a little bit, it's broken the bullish trend line. It's now retesting the underside of it. So
it's struggling to go back above.
Yeah. Overall, though, it's still
it remains supported. If we look at the weekly and monthly chart, if you can.
Yeah, sure. This is the weekly.
Those will show you that the previous high, which was around 1380, currently serves as tentative support. Prices are still circling around it, but in general, these European markets have been pressured in recent, I would even say, years, because of the uncertainty surrounding trade between the US and Europe.
Yeah.
And with the new administration sworn in literally a couple of days,
yeah,
we might see European markets and any European market really pick up steam.
Yeah, and the DAX could be one of those, certainly. So yeah, DAX is looking bullish. May have seen somewhat of a short-term bearish development here. Let's see how today's candle looks like. Okay, so if we get a nice reaction to the downside from here, then that could worry a few bulls, leading to some weakness in the days ahead. However, if you go back above the bullish trend, broken trend line on a daily closing basis, then that would keep the short-term bullish trend intact. The FTSE is looking quite strong. Well, it hasn't been looking quite strong for the last few days, but the longer term picture has been quite strong, hasn't it? And currently the index is holding its own above this key support area, which was formerly resistance. So that area remains key for as long as we hold above, bullish, bearish if you go below. Simple as that. And so if you want to trade this on the long side, maybe it's a good idea to wait for the index to break above this kind of flag pattern on the upside. So flag patterns are continuation patterns, aren't they? And as you can see, it's holding inside this flag. If it breaks above and holds above on the daily closing, then that would indicate that the market wants to push higher. So as a minimum, we would target the most recent high, but then potentially it could go a lot higher from there towards the rising trend. And so that's the situation with the FTSE. Let's now quickly look at the commodities. And crude oil has been rising, but as we mentioned in the previous weeks, we don't expect this trend to continue for too long. Possibly around the $60 mark is where we could see price of crude oil coming weakening again, because at the moment,
if I'm not mistaken, we have been testing the 200-week moving average, which is also a pretty major one.
On the weekly?
Yes.
Indicators, moving average, 200.
No, well, maybe it's only on the US
oil
counterpart. Yeah.
Yes, it is. This is weekly chart of US oil. Yeah, the 200-week moving. I don't really look at this moving edge, but actually it's quite strong, isn't it? Like if you look at the
it's been historically strong and
support and resistance in the past. Yeah.
So could be once again. We'll see. It basically hinges on the habits of consumers to travel.
Yeah. It's going to pick up slowly, consumer travel, if it is this year. It's going to pick up really slowly. Confidence is not going to come back all of a sudden for people to travel. And so I reckon it's going to be a struggle for oil from here. I really do. I want to be positive, but
it already has been struggling over the past several days. So.
Yeah, and also oil has already done what it should have done, given the impact of the OPEC supply cuts and so on. So I think most of the positivity coming from that side is already baked in. So we shall see. Gold and silver still struggling overall. We have been bouncing at this key level of support at 1800 on the weekly time frame. If you look at this chart, this is the weekly chart of gold. 18 was this level here in 2011 and 2012. Strong resistance, broke through that area in 2020. We came down to test this area in November of last year, and this week we hit that level again and it bounced. Overall, in the grand scheme of things, this is still a bullish trend because we haven't even retraced to the 38.2% Fibonacci retracement, which is.
I'm going to challenge you. Can you put on the 3 months chart?
Sure, 3 months. There you go. That's the 3 months.
There you go. Now you see a different picture. You know?
Yeah.
Several attempts to
break.
To cross the 2011 high.
Yeah.
And you know, those for now have been failing. So 1920 is actually the level I'm looking at, and so far it's been holding quite strongly. So we might see you know, a proper unloading of positions from rather big players before. But you're right, 1800 seems to be the other side of the pond. So
so that level needs to break.
100. Really. We couldn't rule out any. We can't rule out anything.
No.
Really. Like
No.
Drop a lot.
I was expecting last month when it started to bounce from 1800 when it created this green candle. This is a monthly chart, by the way. Now, I was expecting gold to take out the previous month's high at 1965. This bearish looking candle's high. It came quite close to that level, but then it dropped. And then what happened next? It went below the high of last month's candle, which it shouldn't have done, right? If it was still strongly bullish. But it broke below it. So 1906 is now kind of the level it needs to break to the upside for me to turn bullish again on gold on this monthly time frame.
Yeah.
So that's the key level. From a daily point of view, what do I need to see from here? Well, one thing that's really interesting.
Back above the 200-day moving average for starters.
It needs to get back above the 200 now.
Yeah, if it closes today and tomorrow below, like we could see
big sell-off.
The start of a breakdown.
Yeah. So as a minimum, I would expect for me to turn bullish once again on gold. I mentioned the level on the weekly, but on the daily, I'd like to see it go back above the 200, and specifically above this high here, this level. Price bullish. So the reason I've selected this level is really simple. This was the last high prior to the latest move down. The latest move down took us below this level right here. See that? We made a low here.
Yeah.
We tried to break that low yesterday.
Yesterday at the opening, it made a really sharp move.
Sharp sell-off, yeah. And it hit that, it almost hit 1800 and it bounced, creating this hammer-like candle. So the downward move started really from this 1865 level right here, 64 right here, a few days ago. So it needs to now break through that level. If it breaks through that, I think it would be a strong bullish signal. Similarly, look, we saw a similar move in the past when it broke through the 200-day and the previous low, and then
it broke back again.
And once it broke,
the only difference is that it had broken back down again below it this time around.
Yeah,
and it definitely looks much weaker than last time.
It does,
and there is scope from a fundamental point
with yields rising.
With yields rising and with basically stability on Twitter coming back to markets. Guys, you have to realize that the past 4 years have been so anxious for many traders when we just start seeing a new trend forming, and then suddenly President Trump tweets something and everything breaks down.
Yeah, we remember that. We remember that.
So we've gotten very used to this. So now that this might disappear from the picture, we could see more chart patterns start to play out.
Yeah, absolutely. But yeah, I mean, it's still going back to gold. It's still a struggle. It's still in consolidation against a long-term bullish trend. So I'll leave it at that. We've marked out our scenarios bullish above this level. Currently, it's kind of more leaning towards bearish point of view than bullish. But yesterday, when it created the hammer, kind of complicated that bearish outlook. So best thing to do right now is to wait. If you're bullish, wait for gold to break above this level. If you're bearish on gold, then I think it will need to drop below 1800 on a daily closing basis this time. Where it is now, it could literally go in either direction. So unless you're trading it short term, that's a different scenario, obviously. If you're aiming for much higher level or much lower levels, then perhaps waiting for some further confirmation would make sense. And finally, looking at silver. Silver is looking stronger out of the two metals. Yes, and the reason for that is silver has dual usages as a precious metal and an industrial material as well. Now, industrial demand could rise for silver because of a rebounding global economy. And also, silver is used in renewable energy, in solar panels, and so on. And with the world economy, with the world kind of leaning towards greener energy, the long-term outlook for silver looks bullish, because I think there will be demand from renewable energy companies for silver, and that could underpin its prices in the long term. In the short term, silver is struggling like gold inside this consolidation pattern. But what I do like from a bullish point of view is that silver, unlike gold, has been printing higher highs. So this was the low. We created a higher low here. This was the previous low. We created a higher low, well, here. Yesterday, it broke this low, but it quickly got rejected, and we went back above the range. So like gold, what I'd like to see for silver is literally a move above the most recent high, which would be here. And if that level breaks, then I think that would indicate that the bulls want to step back in and push the market higher. So like gold, I think it's a wait and see game for silver. Right, I can't see any questions. Can you see any questions, Victor, from the attendees?
No, not at this point.
No, are you sure? Okay, then. If there's no questions, it means everyone's happy for this webinar to end. So we will end the webinar now. Thank you so much for joining us. Join us again at the same time next Tuesday. And in the meantime, have a good week ahead with lots of success and whatnot. And join us again next week. Take care. Bye-bye now.
Good luck. Take care. Bye-bye.